Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Expiration occurs each month. Now, it doesn't mean you have to be buying a one-month option. We might be in the month of July, and you don't have to be trading, let's say, July or August. You could be trading many months out. Options trade until 4/15. An expiration day, if you're trading that expiring month, these options will settle. They'll stop trading at 12 o'clock Eastern Standard Time. They can trade out right now up to 10 months, but they might go out even further in the future, but right now only about 10 months. Generally, price and time are correlated. The more time, the higher the price of an option. So settlement, I think I went through this briefly. Settlement, at expiration, each options are going to settle into zero or their intrinsic value. So if I bought a 100 call and the exchange rate went to, let's say, 104, that option would be worth $4, or if you were a trader in that option and you didn't close it out, you would receive 4 times 100 or $400 back into your account. So these are cash-settled options. They do not settle into a currency. They settle into cash. It's very important to understand that point. So again, exercise an assignment. Someone that is short an option would be assigned. And if you're assigned, you're just basically going to pay the difference, that intrinsic value, if you will, to the buyer. Now, someone might have bought an option for 4 points and it settles at 2 points. That doesn't mean that the buyer made money. In fact, the buyer might have lost money, even though it settles out being worth a couple of points. Remember, settlement is very easy to determine. It's for calls. If that exchange rate value is going to be higher than your strike price, then you have intrinsic value, and that will settle at expiration. For puts, it has to be below, and if it's below, then you're going to receive again some value. But if it's not, in either of those cases, the person that's long the option can't lose any more money than they paid. So there won't be any margin. Let's say, for example, if I bought a 100 call and the exchange rate goes to 82, well, I don't pay any more than what I initially paid. There is no greater loss than my initial premium that I paid. I can't lose any more than that. These options are cleared by the Options Clearing Corp. So initially, the way these trading is set up, you open an account through your broker. The broker sends the orders to the exchange, the ISE. The ISE, if there are trades done, we send messages to the Options Clearing Corp. They actually will settle all these trades. It's very important to understand that point also. It's the largest clearing organization in the world and has a AAA credit rating from S&P. The OCC substantially reduces the credit risk of trading these options, as the OCC requires that every buyer and every seller have a clearing member, that both sides of the transaction are matched. So the options have European style, which means that if you're long an option, you cannot exercise it early, but you can always close it out anytime you'd like. So let's say you bought that 100 call, it goes to 104. You don't have to wait until expiration. You could just sell it out back into the marketplace and get whatever the value is at that time, or you could wait until expiration. Either way. So the options can be closed or cash settled. If ISE-FX options are not closed out and have intrinsic value at expiration, the option will settle into cash. So the OCC settles all the accounts, and they're going to pay, or the accounts will pay or receive the appropriate monies based on the settlement exchange rate on expiration at 12 o'clock noon. Now, if you're long a 12-month option, or I should say a 10-month, that's the longest one that we trade, the settlement value doesn't necessarily matter to you because you have longer life that's still left. But for the expiring options, it's very important to understand that process. How's the cost determined? When you're buying and selling an option, well, there's a pricing model that all the participants are at least looking at, or at least cognizant of factors that go into it. So the market makers will use this every second of the day. They look at the difference between the strike price and the exchange rate value. They also look at the other factors such as time left to expiration, the interest rate differential between the currencies, and the volatility. So these numbers or prices are changing each moment of the day. The option pricing models are helpful tools that enable investors to have reasonable expectations on how an option price should change based on various assumptions. Ultimately, supply and demand change prices. Simply, though, if an option is increasing, well, there are more buyers and sellers, or if it's decreasing, there are more sellers and buyers. Lots of strategies out there. Today, we're just basically talking about buying, but you could actually be trading spreads. You could also be hedging. So there's lots of different ways. Again, I'd urge you to come back, take another class on the different strategies. Option pricing is based on probability, so I just touched on this one. The idea that you have different inputs that go into the pricing of an option, such as the strike price, the currency value, the time left, the interest rates, and the volatility. Volatility is very, very important. Think about it. If you have a currency pair that's trading at 100 and you think it might go somewhere between 50 and 150, well, that option would have a lot more value than another currency pair where you think it might only go anywhere between 90 and 110. So volatility is very, very important. Price movement, that's what volatility really means, how much it might move up or down. Volatilities are dynamic, and the price of financial risk occurs each day in the markets at the ISE. Leverage, what is it? Well, leverage in physics is a factor by which a lever multiplies a force. Leverage in finance is defined as using given resources in such a way that the potential positive or negative is magnified. So leverage is a double-edged sword, essentially. Leverage isn't really good or bad. It's just riskier. Leverage in options. Which options have the greatest leverage? I'm going to pose this to all of the attendees. Which options have the most leverage? In, at, or out of the money. So you put an I if you think it's in, and A if it's an at, or O for out of the money options. Which ones have the most leverage? Let's see. Thank you, Chris. Out of the money options have the most leverage. Does it make them best? No. But if you have a view that the market's going to make a big move and you wanted to implement the best strategy based on that forecast, you would be trading out of the money options. But you have to recognize that those options carry the most risk. Essentially, that if you have no move, you would lose your entire investment. If you bought in the money options and you had no move, you would lose some money, but probably not all that much if the asset didn't fall or rise, depending on if it's a call or put. So the hybrid approach is going to be the at-the-money option. And a lot of people like to trade the out-of-the-money options because they don't offer as much leverage as the out-of-the-money options, but they do offer some leverage. So that's more of a hybrid strategy. Let's go back in. Again, there's no right strategy in, at, or out. Depends on your own risk tolerance and your own financial goals.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.